Right, let's chat about UBS and today's big summit that's taking place here. The quest for yields paying off, according to a new report by UBS and researcher Camden Wealth. Yes, family office investment returns rebounded last year, averaging 7% in 2016, compared with 0.3% the year before. Joining us now from the UBS Global Family Office Summit here in Zurich is Axel Weber, Chairman of UBS. Thank you very much for joining us today and inviting us to this summit. Family offices beefed up their equity allocations last year, and they're planning to increase or maintain their acquisitions this year. What does that tell us about the state of the equity markets on the day that the MSCI All Country World Index is at yet another all-time high?
Right. I think we've seen quite a better mood this time around. As you said, last year returns are better. We've been recommending going long equity for a couple of years now, and we're probably in a mid-cycle phase. Output is growing around potential, and so we think that markets have a few more rounds to go, and that's why we are remaining a long equity.
A couple more years means double-digit percentage gains?
No, it probably will not be as dynamic. We're seeing already that the main driver of markets, which have been sort of in the heydays, really has been very loose monetary policy, where basically fixed income didn't pay off, but equity performed really well. As normalization of central banks goes ahead, that driver of equity markets is disappearing, and it's turning from being a favorable tailwind to something that's going to be more neutral. At the same time, the economies have improved massively. Unemployment is low, so underlying fundamentals in corporations are a key driver of what we will see in the equity markets going forward.
What hasn't stopped equity markets in their tracks is geopolitical activity. How is politics right now affecting at UBS, your client activity in recent months?
Well, politics and geopolitics in general adds to uncertainty. And if you look at what we're seeing in the markets, there is a historically low level of volatility. The VIX is at all-time low or just come off that. And at the same time, if you look at opinion polls about uncertainty or geopolitical uncertainty, that's almost at an all-time high, in the upper 90s percentile. So markets, when faced with such huge geopolitical uncertainty, don't really know how to trade that. And so they step back. People are more in cash. They stay agile. They stay flexible. And that's why you're not seeing such a big drive in the market for investments. Actually, high uncertainty means low levels of transactions. And you hear the reports from the banking, the transaction parts have not been doing well. But at the same time, it doesn't warrant you to undo an investment, say, in equity markets, because it's really not an indicator of future headwinds for equity markets.
2012, you made this focus on wealth management, step back investment banking, wealth management focus. You're number one, as we know, in wealth management across the world. Are you tweaking that? Is there a new push within wealth management? Do you have to fine-tune that strategy which was implemented back in 2012?
No, I think our strategy has been paying off. It's what we always say, an all-weather strategy. We believe that the core of UBS is about wealth and asset management and asset gathering business. That involves a lot of advice for our clients. Events like this, the GFO, the Group Family Office Summit. We have clients come here to seek advice, to look at our investment opportunities. And at the same time, investment banking is part of the picture. Many of the family offices have as complex investment strategies as some of the hedge fund or other financial institutions. So you need the capabilities and the structuring capabilities in particular of an investment bank. So we think our equity business, which is at the core, or our corporate client advisory business in the investment bank, is actually adjacent to some of the business we do in our wealth management, because many of our investors are long equity. So having transactions in equity helps us to maintain that momentum. So not really anything that warrants going back and doing a strategy
Are you
review.
happy with the size of the investment bank?
We're happy with the size of the investment bank. We're not happy with the number and with the size of transactions that happen, but that's a problem everyone faces. So transactional activities have been low, but in general, yes, I think our strategy is in the right place. The core of the business supplemented by an investment bank and an asset management business, but focused on wealth management, is where we want to be, in particular as a Swiss bank.
Trading revenues at Citigroup, it was announced yesterday, could fall as much as 15% in the current quarter. Can you give us a taste of your experience in the third quarter? Are you mirroring what they're saying?
We never give any updates
worth
in
a try.
between. It was worth a try, but our next rendezvous with the markets is going to be end of October, early November, where our executive team will report. But of course, we're part of the industry. But at the same time, wealth management drives a lot more of our profitability and a strong domestic business than for many other banks.
You're charging clients in the Eurozone and Switzerland for excessive cash holdings. That's caused outflows here in Europe. Are clients decreasing their cash levels right now?
It's not by choice. It's by way of regulatory requirements that we do that. And yes, clients are looking into alternatives to cash. Short-term investments is something clients are looking into. But in general, uncertainty around future strategies, in particular in monetary policy, still leads to clients sort of staying out and just tiptoeing back into markets. But there's not really a drive of people getting out of cash and reinvesting in the markets, else our transaction numbers would be better.
Within wealth management, where are new assets coming from right now?
New assets are coming from basically, a lot of additional assets, organic growth of already existing clients who are investing somewhat more, and then being the largest wealth manager and probably the only truly global wealth manager. We see inflows in particular in Asia, where our wealth management has been doing and performing well. We see a turnaround of our business where we've seen some outflows over recent years in Europe, to that stabilizing and turning to more normal dynamics. And it's a traditional business that is doing well.
Can you give us an idea of the size of the inflows you're expecting this year and maybe in 2018?
Well, over the last few years, we've had between 40 and 50 billion of net new money in each and every year, and that's kind of in our medium to long-term plan. So we expect to grow sizably, and if you compare that over the 5 years, we actually grow by the size of a normal mid-sized wealth manager organically rather than through acquisitions, and that's the focus of what we're doing.
Let's talk about the ECB. Can you put your ECB hat on, your central banker's hat on, your former central banker's hat on? Should the ECB be worried about the level of the euro?
I don't think the euro in itself is a part of the decision framework of the ECB. It's part of the data frame they analyze. And yes, a stronger euro will actually mean that they face headwinds on some of the traditional indicators that they're looking at. For example, if you look at the developments in the economies that are very export-oriented, so an appreciation does undermine a bit the economic momentum. At the same time, it impacts on price developments in a way that...
Does it slow the normalization path?
I don't think it'll slow it or should slow it, but clearly what the ECB and the Fed are looking for is inflation moving more towards their target. I've made continuously remarks that inflation around 2%, you cannot fine-tune that. So as long as the medium-term inflation prospects are in place, I think a forward-looking monetary policy should continue to normalize. For the Fed, that means for me that I don't rule out that there will be another interest rate move, and I definitely expect that they will announce how they will reduce the size of their balance sheet and start acting on that. For the ECB, look, we're in a mid-cycle recovery. Labor market has tightened, but we're not seeing capacity constraints yet. So over time, as the economy continues to improve, we expect inflation to pick up and to continue to rise. And I think the ECB is just waiting for that signal to continue its normalization.
What's the sequencing? What's Axel Weber's sequencing when it comes to policy from here? Everyone's looking at October, the next meeting. What's the sequencing from where you're sitting?
I think they haven't had any substantial discussion on how to reduce the size of the balance sheet over the summer, so those debates are taking place now. Whether they come up in October or at a later meeting in November, I think they will definitely have to come up with giving markets a clear indication of where they're going in 2018. Tapering the balance sheet is on, in my view, the menu. And they will announce that probably, in our view, at the next meeting or the meeting after. The main issue will be the sequencing also of the policies. The ECB has announced that they will reduce the purchases eventually to zero and then start raising interest rates. So my expectation is that over the remainder of Mario Draghi's term in office, which is November 2019, he will want to leave with a clean plate, and that is no more unorthodox policy in the sense of augmenting the size of the balance sheet through purchases and no interest rates in negative territory. And for that to happen, I think 18 has to be the year of tapering, and 19 will be the period where they reduce, where they lead interest rates into positive territory again. That's my expected sort of time pass ahead, and it'll all happen before the end of 19.
Let's talk Brexit. Are you leaning towards Frankfurt for your trading headquarters post-Brexit?
Well, at the moment, a key input into that decision is actually the post-Brexit arrangement between the UK and Europe on financial markets. We don't have that decision variable yet. So what was key for us is to gain optionality. We do have all the optionality we need. We have a large operation in Frankfurt. We do have a trading operation that we can increase anywhere in the European environment. And I think the key issue for us will be the legal entity discussion, which is where is your European operations? That's now in Frankfurt. And where do you have the client-facing front offices? That could be in a number of locations. It could be spread out in various locations where the clients are. But that's a decision we'll have to take towards the end of the year.
Can you tell us the costs of all this? What are the costs? The Brexit costs for UBS?
The Brexit costs are higher if you don't have the optionality. So you have to look at diversification of your business. No, I can't give you figures because it really depends on the end stage. A hard Brexit, or as
let's say it's soft.
A soft Brexit will mean that things are gradual and it'll be part of the change the bank modus. It'll be very close to run the bank operations, where you start basically moving operations closer to clients and changing the legal framework. The big issue is whether, for example, and Deutsche Bank and others have faced that, especially the European banks, will we continue to run on a branch-like operating framework in the UK with the headquarter of that European operations in Frankfurt? And that's a variable we don't yet know about. And that will be a key decision variable.
Mr. Weber, in a word, otherwise I'll be told off by my producer in my ear. What's your biggest worry? What keeps you awake at night?
What keeps me awake at night is geopolitical risk at the moment. At the moment, I think
a specific one?
I think North Korea, Syria, the whole Ukraine issue. Those are issues that could come to the fore and have a big market impact anytime soon.
He's not telling me off. Thanks for joining us today, Axel Weber, Chairman of UBS. Thank you, sir.